1 week to go now until the first anniversary of the collapse of Lehman Brothers. The one-time financial giant filed for bankruptcy and ignited the worst financial crisis since the Great Depression.
So, a year later, what lessons have we learned from Lehman's collapse? Bloomberg News reporter Bob Ivory here to explain. Bob, Lori and I were saying during the commercial break, where did that year go? It has been almost a year.
Yeah, September 15th was the day that they filed for bankruptcy, and that's 1 week from today.
Talk to us about the chronology of events here and how that led us into this financial crisis that the nation's facing now.
Well, September 12th last year was a Friday, and the Secretary of the Treasury, Hank Paulson, called all the world's most powerful bankers together at the New York Fed with then Fed President Tim Geithner. And he said, there's not going to be a government solution to Lehman Brothers. We want you guys to solve the problem of Lehman. It looked like it was collapsing, the bank. And so over the course of a couple days, Saturday and Sunday, they tried to find a buyer for Lehman. And then when they couldn't find a buyer, they decided that their job would then be to mitigate all the consequences of the Lehman bankruptcy. Well, they did forget one thing, and that was the $3.6 trillion market, the money market funds. And that's where people put their money that gets a little higher interest than bank deposits.
And the irony is that you just said they did forget. How do you forget something that's $3.6 trillion?
Well, they did. And the short-term loan market, it's called commercial paper, was also affected. So you had this part of the economy that companies and banks use every single day to fund themselves just freeze up because of a little bit of Lehman exposure and a run on the money market funds, and that was not was completely overlooked on that weekend.
Bigger picture, Bob, what do we know now? What have we learned about why Lehman was allowed to fail, this too big to fail notion, yet AIG was spared and others?
You know, Lori, I'm not sure that we'll ever find a satisfying answer for that.
Fair enough.
There's a lot of stuff happening that week. You know, Fannie Mae and Freddie Mac were rescued on the 7th of September.
And the Fed facilities.
All the Fed facilities were put in. You had AIG that week. We had AIG, you know, the 2 days after Lehman's bankruptcy, and you had Merrill Lynch being bought by Bank of America. That all in that 2-3 week period. So, you know, one of the advisors to Paulson told me, he said, you know, we tried to take care of everything that we knew of, and then just react to the rest. So, you know, these are human beings we're talking about. They're not. They just did not have their minds around the entire system.
And Bob, speaking of human beings, the toll Lehman's victims, who were they?
Well, I think that Lehman's victims first were the employees and the investors, and certainly, you know, our series, which is running all week this week on the repercussions of the Lehman bankruptcy. On Thursday, we're having a story about investors in Hong Kong who lost a lot of their money. Some of them lost their entire retirement funds. So this was something that didn't affect just it was a global, what really was a global ripple effect.
Characterize how tight the credit markets are today. You mentioned the commercial paper issue that's loosened up. Some companies are able to do day-to-day business, but generally speaking, if it's possible to give a wide answer, how tight are credit markets? I mean, that term credit-free seems to be pushed away now.
Well, I think that from my perspective, and I try to take the long view on this, you know, not what's happening today and tomorrow, but if you don't have government propping up the credit markets, they're still propping up the commercial paper market and the money markets. So if you don't have that government involvement, I don't know where we'd be today. And you have a kind of an artificial, if you will, bolstering of both of those very key markets by the government.
But they're stepping back.
Right.
Well, they're supposed to be stepping back soon, and we'll certainly, you know, they keep postponing the time when they're going to take away their support. So yeah, we're gonna. I think there might be some news out of there.
And amid a lot of criticism, President Obama was quick to point out. He said, "Well, unfortunately, we don't want to do this, but government's the only entity big enough to take care of this."
Right. You know, we're talking about lessons learned, lessons not learned. I'm not sure governments learned the lesson of the Lehman bankruptcy, but the banks are starting to. And they're starting to really play off of that kind of almost explicit support by the U.S. government.
But are they still too big to fail?
Well, I had one economist tell me that any bank with assets over $500 billion is quote unquote too big to fail, to be allowed to fail. And we have more than a dozen banks, I think, with that. I have to check that, but I think we have a few banks like that. And they know, and we know, that after Lehman, after the catastrophe of Lehman, the U.S. government's not going to allow a bank that big to go down again. So that they could play off that and maybe make more risky bets because of that.
Bob Ivory, many thanks.
Sure.
And it's series all week on
all
Bloomberg.
week long.
Bob, thanks so much.
Thanks a lot.
Appreciate it.